Okay, 7th of February, Rudy here. So what is this fantastic ETF? Well, before we have a look, just want to go through to make sure you understand what the Royal ETF is, because it's a bit like a pretty lady with a bad heart. So the Royal ETF, as the mantra says, they invest in companies, a royalty company, which is a company which invests money in a business and in return gains a share of future revenue. No operational risk. Bingo. Tick. Really great. And then you cap it off with every month a 5.6% annualized distribution. My God, what a ripper. Look at that consistent monthly income. Okay, so in the Royal, so we've got two, so Wheaton and Frank, we'll go through just these ones, but you can see it's heavily weighted to these two gold royalty companies. So let's just have a look at them, see what's under the hood. So I should the Royal ETF has also given you so since January 24 today, a 56% capital return. My God, back up the truck. Okay, so Wheaton, so this is the biggest holding. So what these companies do is they give money to a mining company could be fund exploration, fund development, fund mine expansion. So they give them money, but not for shares, but for a percentage of their future gold sales or silver sales. So that's the no operational risk part of it. Doesn't matter if their costs blow out of the miner, they've got to pay the royalty. But the thing is, this company itself, the dividend pays is 0.5%. Okay, so this is where it gets interesting. So Franco-Nevada, they're the same business model as Wheaton, but their dividend is 0.8. Texas Pacific, they're sort of in the same business, but in oil and gas. Beautiful chart. I'd buy that. But their dividend is 0.7. Then you got Universal Music. So I'm sure you know who they are. Okay, so they're killing it. Their dividend's 2.6. Then you got Royal Gold. So they're a bit like Wheaton. So their dividend's 0.75. And then we got GMAB, which looks like it's going to correct. That's where that other one, that's where this one was. Back to it. Okay, so they're in the drugs, royalties from drug sales, but they don't pay a dividend. And then ARM, chip manufacturing, doesn't look too bad, but they don't pay a dividend. Okay, so if this Royal ETF is just investing in these companies, and the dividends from these companies, call it, well, let's be generous, say 1% per annum, how can they afford to pay a monthly distribution of 5.5%? Yeah, well, the only logical thing is that extra 4.5% comes through selling down units or selling down shares in these companies to make that up. So if the share, which has been a great business model, because you can see the likes of this have just gone up. So nipping 5% a year out of it wouldn't make a difference. Okay, you get the gist. So the underlying companies are not funding that 5.5%. Okay, so there's two options here. So there's a new ETF in Australia which is based off this SIL ETF in America, where you can see the top holding is Wheaton, 21%. It's actually a silver miners ETF, but Wheaton's the top holding. And this ETF, since January 24, has returned 278%. So imagine if you just invested in this and say paid yourself a 15% per annum distribution, a lazy 15%, you'd still be ahead of investing in the Royal. Now this SIL ETF is now that looks pretty scary. This is the new one, and I'm not saying you should do this, because if I know you're an income investor, I'm just trying to make the point, and I'll get to the answer. So this SLVM is the same as SIL. Okay, so it's the same as that. It's just representing this these 2 weeks. So you could do that and pay yourself a healthy dividend. Or the other option is, we don't have an ETF, unfortunately. This is the XCJ, which is our energy index. Okay, so this is made up of our oil and gas miners like Woodside, Santos, and there's a whole bunch of other ones. And most of them are paying fully franked dividends over 5%. So you get real dividends from the companies and real franking credits paid to you. And if we want to look at like capital growth, if we do the ratio of, make sure I get the ASX version. So the ASX version of the energy index over Royal. So what we've got here is a bit of a bottoming formation, which is implying that the energy index is going to outperform the Royal ETF. So not only will these energy stocks pay you a fully franked dividend over 5%, matching Royal, you might even get some extra capital growth over Royal. All right, if you want to know more, join the channel. $10 a month. I do daily videos, cover dividend stuff, find out which oil stocks you should be buying. And I'd love to hear your feedback if you're a current Royal investor and didn't quite think that's the way it worked. All right then, have a good one. See ya.